Okay, let's unpack this. It is Wednesday, February 4, 2026. And if you have been brave enough to look at your portfolio app this morning, or even worse, doom scroll through the crypto markets, you might be getting that sinking feeling.
Oh, yeah.
You know, the one where you start wondering if you should have just stuck to index funds?
Or maybe just, kept cash under the mattress.
Exactly. The vibe is heavy. I popped into the Reddit daily discussion thread earlier just to take the temperature, and Grim is putting it lightly.
Really?
Oh, yeah. You've got threads titled, "Why is Solana Dying?" People writing these eulogies for their altcoin bags, and this agonizing tug of war between total bear market despair and people just praying for some kind of, mini bull run miracle. It's messy out there.
It is messy, but that noise, that emotional roller coaster, is exactly why we do this. Because while the retail traders are staring at red candles and panicking, the actual plumbing of the financial world, I mean, the infrastructure that nobody sees until it breaks,
Yeah.
is shifting. And there is one network that seems to be sitting right in the middle of that shift, quietly integrating with some of the biggest financial engines on the planet.
And that's our deep dive for today. We're talking about Stellar XLM. And before you roll your eyes and think, great, another token pitch, just stop. This isn't a price prediction show.
Not at all.
We'll talk about the numbers later because we have to, but the mission today is different. We need to figure out if Stellar is finally realizing that decade-long promise of being the bridge between traditional finance TradFi and crypto.
It's a huge question.
Yeah.
And to answer it, we've pulled together a really diverse stack of sources. We're looking at technical developer documentation on a massive upgrade they're calling Protocol 25.
Okay.
We have reports from the World Economic Forum in Davos from just a couple of weeks ago. We've got announcements from the CME Group, the Chicago Mercantile Exchange, and we'll even parse through some of those spicy social media rumors to separate the signal from the noise.
The specific lens I want to use today is maturity. For years, crypto has felt like a casino. But with things like privacy upgrades and these new institutional vaults coming online, are we finally seeing the transition to legitimate financial utility?
That's the key question. And specifically, we need to look at how privacy and institutional vaults might be the missing keys that finally unlock the kingdom for the big banks. It's about moving from, experimentation to production.
So let's start with the big picture. You mentioned Davos 2026. Usually when the crypto crowd goes to Davos, it feels a bit like they're at the kids' table.
Right, handing out stickers while the adults discuss interest rates.
Exactly. But looking at the reports from the Stellar Development Foundation, or SDF, this year felt different.
It was a very different tone. The conversation has shifted from if crypto to how crypto. The SDF presented this framework they called two coordination models. Now, that sounds dry, but it's actually a pretty radical way to look at how the world is organized.
Two coordination models. Okay, break that down for us. What's model number one?
Model 1 is committee-based coordination. This is the legacy system. It's how the world works right now. Think of SWIFT, SEPA.
Or just your local bank. Lots of meetings, boardrooms, and handshakes.
Exactly. It relies on human consensus, negotiation, and all these bilateral agreements. If Bank A wants to send money to Bank B in a different country, they need an agreement. They need intermediaries.
It's slow.
It's slow, it's manual, and it's incredibly expensive to maintain because you're paying for all those humans to check the work.
Okay, and model two?
Model 2 is code-based coordination. That's the blockchain model. The protocol is the agreement.
Right.
You don't need a committee to vote on whether a transaction is valid. The code just does it, deterministically. If the inputs are correct, the output happens. No meeting required.
So on one side, you have humans in a room making decisions slowly. On the other, you have code executing rules instantly. The SDF's argument at Davos was that we aren't seeing a war between these two, but a convergence.
Right. It's not about burning down the banks or replacing every human with a script. It's about integrating the accountability of the old world with the efficiency of the new code-based world. It's taking the rules the committees made and just enforcing them with code.
I love that concept. But, humans are stubborn. Sometimes it takes a disaster to make people appreciate a new system.
Yeah.
And speaking of which, we have to talk about the server in the room. That AWS outage from October 2025.
That was a massive wake-up call for the committee model.
A huge one. For those who managed to block it out of their memory, we're talking about a 15-hour outage. It affected over 1,000 firms, financial services, tech companies. Screens just went dark. I remember trying to access my own bank app and getting nothing.
Back to spinning wheel. It's
Yeah.
chaos. And Stellar really used that event to drive their point home at Davos. When you rely on centralized cloud servers, which is what the whole committee model runs on, you have a single point of failure.
A huge one.
If Amazon Web Services goes down, the committee can't meet. The bank doors don't open. The ledger effectively disappears for those 15 hours.
But an open blockchain keeps running.
Exactly.
Yeah.
A decentralized network doesn't run on one server farm in Virginia. It runs on thousands of nodes globally, operated by all these different entities. So if one node goes down, or even 100 nodes go down,
The network persists.
it persists. The argument Stellar made was all about resilience. It's not just crypto is cool. It's crypto stays online when the cloud goes down.
That's a powerful pitch to a risk manager at a bank. Hey, maybe don't put all your global financial eggs in one server basket.
Precisely. And that resilience is becoming a major selling point for institutions who are terrified of downtime. In the old days, they worried about crypto being unstable. Now they're realizing the centralized web is the fragile thing.
Okay, so that's the philosophy, code versus committees. But philosophy doesn't pay the bills. Let's talk about the money, because as 2026 kicked off, Stellar hit a pretty massive milestone.
They did. As of the start of this year, the Stellar network officially crossed $1 billion in tokenized real-world assets.
Wow, that's a number with a B.
And just to be clear for everyone listening, we aren't talking about random meme coins here.
No, not at all.
We are not talking about pictures of monkeys.
No, these are real-world assets, or RWAs. This is treasury yields, legitimate financial instruments, and currency. And the players driving this volume are heavy hitters. We're seeing PayPal expanding their blockchain payments. We're seeing Franklin
A
Templeton
massive asset manager.
and Ondo Finance. I mean, Franklin Templeton has been a pioneer here. They have a money market fund on Stellar where you can hold your shares in a digital wallet.
Right.
And that $1 billion figure proves that this isn't a pilot project anymore. It's a production environment. When you have $1 billion of value sitting on the network, it changes the conversation from does this work to, okay, how do we scale this?
Which is a much better question to have.
Right. But there was a specific piece of news that dropped just yesterday, February 3rd, that I think really illustrates how these big players are getting comfortable. We need to talk about Rails. Rails. This is a regulated crypto derivatives provider. What did they launch?
Yesterday, they launched institutional-grade vaults on Stellar.
Institutional grade vaults. It sounds heavy. Why does this matter? Is it just marketing speak?
No, not at all. To understand why this matters, think back to the FTX collapse. What was the absolute biggest problem there?
Well, aside from the fraud, it was that they took user money and did things with it. They commingled funds. You had to trust that the exchange wasn't gambling with your money.
Exactly. That is called counterparty risk. You are risking your money on the honesty of the other party. What Rails has done on Stellar is solve that with code. The collateral for these institutional trades is held in on-chain, audited smart contracts.
So it's completely separate from the operating funds of the company.
Completely. If I'm a big bank and I want to trade crypto derivatives, I don't have to trust that Rails is being honest. I don't have to trust their CEO. I can verify on the blockchain that my money is sitting in a vault that they physically cannot touch. It removes the whole trust me bro element of finance.
That feels like the grown-up version of crypto.
It is. It's the infrastructure needed for traditional finance to actually use blockchain without getting fired because the exchange went bust.
Okay, this is where it gets really interesting to me. We always talk about adoption, but adoption is usually just boring infrastructure upgrades like this. It's not always a Super Bowl ad.
Boring is good. Boring is stable. And speaking of upgrades, we have to talk about the tech that's enabling all this. Because Stellar is rolling out a new upgrade called Protocol 25.
Codenamed X-Ray, which I have to say is a much cooler name than Protocol 25.
It is. And the name X-ray is intentional. Think about what an actual X-ray does. It lets a doctor see inside your body to see the bones without, cutting you open.
Right, without exposing everything.
Exactly. In this context, it's a tool to show only what needs to be seen.
So we're talking about privacy.
We are. Protocol 25 introduces zero-knowledge, or ZK, cryptography primitives, directly into the Stellar protocol. Specifically, it adds native support for two things: an elliptic curve called BN254 and a hash function called Poseidon.
Okay, hold on. You're getting into the alphabet soup. BN254 sounds like a droid from Star Wars. Why do I, as a listener, care about a specific elliptic curve?
Fair enough. Let's strip the math away. Here's twofold. First, BN254 is the standard used by Ethereum ZK applications, things like StarkNet or ZK email.
Oh, so it's a compatibility thing.
It is. By adding native support for this specific curve, Stellar is basically rolling out the red carpet for Ethereum developers. If you build a privacy app on Ethereum, you can now migrate it to Stellar without rewriting all your math.
It's like a universal power outlet.
Perfect analogy. It just lowers the barrier to entry. But you mentioned a second point, and I suspect this is the one the banks really care about.
The Holy Grail.
The holy grail for banks, privacy plus compliance.
Unpack that. Why can't banks just use a public blockchain? Why do they need X-rays?
Because transparency is a double-edged sword. If JP Morgan is moving $1 billion on a public ledger, everyone sees it. Their competitors, Goldman Sachs, high-frequency traders, they all see that order coming.
And they can front-run it. They can trade against it before the order even settles.
Exactly. Transparent ledgers are great for accountability, but they are terrible for trade secrets. Banks need transfer obfuscation. They need to hide the details of the trade, the amount, the asset, the participants. But, and this is the big catch, they also need to prove to regulators that the money isn't dirty.
It's a paradox. How do you prove a transaction is legal without showing the transaction?
That is what Protocol 25 and this X-ray tech allow. Using zero-knowledge proofs, a bank can mathematically prove a transaction is valid and compliant.
Without revealing the sensitive data.
Without revealing any of it to the public. They can prove they followed the rules without showing their hand. That is the convergence we were talking about. It's code enabling private compliance.
That is huge. You'd think with $1 billion in assets, institutional vaults, this crazy X-ray privacy tech, the market would be throwing a parade for Stellar.
And that brings us to the harsh reality check.
Yeah, let's look at the scoreboard. Because there is some major financial news. The CME Group, Chicago Mercantile Exchange, is launching Stellar Futures. And that is happening, what, next week?
February 9th, 2026, next Monday.
That is massive validation. The CME is the big leagues. This isn't some offshore crypto casino.
It's the real deal. They are launching standard contracts for 250,000 lumens and micro contracts for 12,500. This puts XLM in the same regulated playground as Bitcoin and Ether. It signals institutional maturity.
And it allows the big players to hedge, which means they're less afraid to hold the asset in the first place.
Exactly. It makes holding the asset much safer for a corporate balance sheet. It invites the big money to stay longer.
And yet, despite this institutional safety net appearing, I'm looking at the price action. XLM is just consolidating between, what, 19 cents and 23 cents?
Yeah.
It's trading below its 200-day moving average. Technical analysis suggests maybe a breakout to $0.27, but right now, it's just crickets.
It's a classic disconnect. The technicals look weak. The sentiment is weak.
It feels like the market is bored. I was reading through that Reddit daily discussion again, and the frustration is just, it's palpable. People feel totally burnt out. Altcoins are dead. Bear market. You know the drill.
There's a massive gap right now between the building and the trading. The builders, SDF, Franklin Templeton, the CME, are laying down infrastructure that will last for decades. The traders are looking for a green candle today, and when they don't see it, they assume the project is dying.
It's funny you mentioned dying, because usually when the price is boring, the rumor mill starts spinning. And we saw a weird flare-up of drama just a couple of days ago regarding, of all people, Jeffrey Epstein.
Yeah, we have to touch on this because it was all over social media on February 2nd.
This feels like total noise, but walk us through it so we can just put it to bed.
It is noise. Basically, some emails were released from way back in 2014. They linked Epstein to a dispute involving the early days of Ripple and Stellar.
2014. That is 12 years ago.
Correct. And Ripple's David Schwartz came out immediately and denied any connections, effectively squashing it. It's classified as bearish noise. It has absolutely zero impact on the fundamentals of the network in 2026. It's just drama.
Okay, so that's the noise. Let's pivot to the signal. If we ignore our 12-year-old emails, what's the document we should be looking at?
If you want a signal, look at the patent filed by the DTCC in 2025.
The DTCC, the Depository Trust and Clearing Corporation.
These are the guys who basically settle the entire U.S. stock market. Quadrillions of dollars in securities flow through their pipes.
So the backbone of Wall Street.
The absolute backbone. They filed a patent that explicitly names XRP and XLM Stellar as tools for tokenized liquidity.
Wait, they named them specifically in the patent.
Specifically, not just blockchain technology or distributed ledger, but XLM. Now compare those two things. On one hand, you have a rumor about a 12-year-old email. On the other, you have the entity that processes Wall Street naming Stellar in a patent for the future of liquidity.
When you put it that way, the signal is blindingly bright. It sounds like the committees of the old world are already writing the code into their future plans.
That's exactly what's happening. They aren't posting on Reddit about price targets. They are filing patents and launching futures contracts. They are preparing for the convergence.
So to recap where we are today, February 4th, 2026, we have a network that is deploying advanced privacy tech with Protocol 25. It has hit $1 billion in real-world assets. It is getting listed on the CME next week. And yet the retail market is gloomily staring at charts, wondering if the sky is falling.
It's a textbook case of asymmetry. The fundamentals are accelerating while the sentiment is stalling. And usually, eventually, price follows fundamentals. But the timing, that's the part nobody can predict.
It really makes you wonder what the catalyst will be to wake everyone up.
Well, think about where we ended up with a philosophical argument. We are moving toward code-based coordination.
Right.
So here is a provocative thought to leave you with. If the future of finance is indeed code-based, and if tools like X-ray allow for private compliance, what happens to the concept of an audit?
What do you mean, like the annual audit a company goes through?
Exactly. Right now, an audit is a paper trail. It's humans in suits checking receipts, sampling data, and trusting that the company isn't hiding boxes of documents. It is slow, fallible, and it looks at the past.
Sure, it's a snapshot in time.
But are we ready for a financial system where the audit isn't a stack of papers, but a mathematical proof? Where we don't trust a Big Four accounting firm to tell us a bank is solvent, but we trust a zero-knowledge proof that verifies solvency in real time every single second.
An audit as a living math problem.
Exactly, because if that happens, the entire structure of trust in our economy changes. It's not just about faster payments. It's about proving truth without revealing secrets. And Stellar seems to be building the exact machine to do that.
That is a heavy thought to chew on. From Solana is dying threads to the future of mathematical truth. That is why we do the deep dive.
Always a pleasure to connect the dots.
Thanks for listening, everyone. We'll catch you on the next one. Keep your eyes on the signal, not the noise.